Tariffs are taxes on imported goods. They make foreign products more expensive for consumers. Governments use tariffs for a few reasons. One reason is to protect domestic industries from foreign competition. Another reason is to generate revenue for the government. Tariffs can also be used as a bargaining chip in trade negotiations. However, tariffs can have unintended consequences. They can lead to higher prices for consumers and businesses. Tariffs can also spark retaliation from other countries, leading to trade wars. These trade wars can damage the global economy. It's important to understand the role of tariffs in international trade. They are a complex tool with both potential benefits and risks. President Trump has made tariffs a central part of his trade policy. He has imposed tariffs on goods from China, Mexico, Canada, and the European Union. The stated goal of these tariffs is to protect American jobs and reduce the trade deficit. These tariffs have been met with mixed reactions. Some businesses and workers in industries protected by tariffs have praised the move. However, many other businesses have criticized the tariffs, arguing that they will lead to higher costs and job losses. The tariffs have also strained relationships with key trading partners. Several countries have retaliated with their own tariffs on American goods. This tit-for-tat escalation has raised concerns about a potential trade war. The stock market is a forward-looking mechanism. It doesn't just react to what is happening now, but also to what investors believe will happen in the future. This predictive nature makes it highly sensitive to news and events that could influence economic conditions. It reacts to news and events that are expected to impact the economy in the future. When significant news breaks, such as the announcement of new tariffs, the market quickly adjusts as investors reassess their expectations. The imposition of tariffs has introduced a significant level of uncertainty into the global economic outlook. Tariffs can disrupt global supply chains, increase costs for businesses, and lead to retaliatory measures from other countries, all of which can have far-reaching economic consequences. This uncertainty has spooked investors, leading to volatility in the stock market. Investors hate uncertainty because it makes it harder to predict future earnings and economic conditions, which are crucial for making informed investment decisions. When tariffs are announced or implemented, the stock market often experiences a decline. This is because investors immediately start to factor in the potential negative impacts on corporate profits and economic growth. This is because investors fear that tariffs will hurt corporate profits and slow economic growth. Higher costs for raw materials and components can squeeze profit margins, while reduced access to international markets can limit revenue growth. Companies that rely heavily on global supply chains or export a significant portion of their products are particularly vulnerable to the negative effects of tariffs. These companies may face higher costs and reduced demand for their products, which can lead to lower earnings and stock prices. The market's reaction to tariffs can be swift and dramatic, as investors try to price in the potential impact on corporate earnings and economic growth. This rapid adjustment can lead to significant short-term volatility, as market participants scramble to reassess their positions and strategies. Economists are divided on the long-term effects of tariffs. Some argue that tariffs are a necessary tool to protect domestic industries and jobs. They believe that strategic use of tariffs can help to rebalance trade relationships and create a more level playing field for American businesses. However, many economists warn that tariffs are likely to do more harm than good. They argue that tariffs will lead to higher prices for consumers, reduced economic growth, and job losses in industries that rely on imported goods or export markets. The consensus among economists is that tariffs create winners and losers. While some industries may benefit from protectionist measures, others will inevitably suffer from higher costs and reduced competitiveness. Bulls versus bears, conflicting views on tariffs. Financial news outlets and investment websites are filled with conflicting opinions on the impact of tariffs. Every day, new articles and reports emerge, each presenting a different angle on how tariffs might shape the economic landscape. This constant influx of information can be overwhelming for investors trying to make sense of it all. Some analysts, often referred to as bulls, believe that the market has overreacted to the trade tensions. They see the current situation as a temporary setback, a bump in the road that the market will soon overcome. These optimists argue that the fundamentals of the economy remain strong, with robust consumer spending and low unemployment rates. They argue that the tariffs will ultimately be short-lived and that the economy is strong enough to withstand any temporary disruptions. Bulls often highlight the resilience of businesses and the adaptability of supply chains, suggesting that companies will find ways to mitigate the impact of tariffs over time. On the other hand, bears are more pessimistic. They see the tariffs as a significant threat to economic stability, potentially leading to prolonged periods of uncertainty and market volatility. Bears caution that the ripple effects of tariffs could be far-reaching, affecting not just the stock market but also global trade relations. They warn that the tariffs could trigger a global trade war, leading to a recession. The fear is that escalating trade tensions could result in retaliatory measures from other countries, creating a cycle of economic retaliation that could be difficult to break. They point to historical examples where protectionist policies have had unintended negative consequences for the global economy. Instances from the past, such as the Smoot-Hawley Tariff Act of 1930, are often cited as cautionary tales of how protectionism can backfire, leading to reduced international trade and economic downturns. Investors are bombarded with a constant stream of information and analysis, making it challenging to discern which viewpoint to follow. The sheer volume of conflicting opinions can lead to confusion and indecision, as investors struggle to separate noise from valuable insights. It's essential to consider multiple perspectives and develop an informed investment strategy. By weighing the arguments of both bulls and bears, investors can better navigate the complexities of the market and make more informed decisions that align with their financial goals. Navigating the storm advice for investors. Market volatility created by trade tensions can be unsettling for investors. The constant ups and downs can make even the most seasoned investors feel uneasy. It's during these times that having a clear strategy becomes even more crucial. However, it's important to remember that volatility is a normal part of the market cycle. Historically, markets have always experienced periods of turbulence followed by recovery. Understanding this can help investors maintain perspective. Instead of panicking, investors should focus on developing a sound, long-term investment strategy. This means setting clear financial goals and sticking to them, even when the market seems unpredictable. Diversification is key to mitigating risk. By spreading investments across various asset classes, investors can protect themselves from significant losses in any one area. Investors should ensure that their portfolios are not overly concentrated in any one sector or asset class. This balanced approach can provide a buffer against market volatility. This will help to cushion the blow if one particular area of the market is negatively impacted by tariffs. For instance, if trade tensions affect manufacturing, other sectors like technology or healthcare might remain stable. It's also important to stay informed about developments in the trade negotiations. Keeping up with the latest news can help investors make timely decisions and adjust their strategies as needed. Investors should monitor news from reputable sources and be wary of rumors or speculation. Reliable information is crucial for making informed decisions. Making investment decisions based on incomplete or inaccurate information can be costly. Always verify the credibility of your sources before acting on any news. The global ripple effect. The imposition of tariffs has far-reaching consequences that extend beyond the borders of the countries directly involved. Tariffs can disrupt global supply chains, increase costs for businesses around the world, and reduce demand for goods and services. When one country imposes tariffs on another, it can trigger a domino effect. The targeted country may retaliate with its own tariffs, leading to a tit-for-tat escalation. This can create a climate of uncertainty and instability in the global economy, making businesses hesitant to invest and hire. The interconnected nature of the global economy means that tariffs imposed by one country can have unintended consequences for businesses and consumers in other parts of the world. Beyond the bottom line, unintended consequences. While the focus of the tariff debate often centers on economic impacts, it's important to acknowledge that tariffs can have broader social and political ramifications. Tariffs can lead to higher prices for essential goods and services, disproportionately impacting low-income households. Tariffs can also fuel nationalist sentiment and exacerbate tensions between countries. When governments resort to protectionist measures, it can erode trust and cooperation on other global issues, such as climate change and security. the true cost of tariffs extends beyond the balance sheet. It's crucial to consider the potential social and political consequences of these policies. The road ahead: uncertainty and opportunity. The future of global trade remains uncertain. The outcome of ongoing trade negotiations will have a significant impact on the global economy. If tensions escalate and a full-blown trade war erupts, it could have severe consequences for businesses and consumers around the world. However, periods of uncertainty can also create opportunities for investors. Market volatility can create buying opportunities for those who are willing to take a long-term perspective. Investors who can tune out the noise and focus on fundamentals may be able to capitalize on market dislocations. The key is to stay informed, remain disciplined, and avoid making rash decisions based on fear or speculation.